Welcome to this week's update on the hedged option portfolio. As you can see from the chart, this week has been kind of insane, with new all-time highs being set almost every day. Fantastic news for spot holdings, but not so great news for trading accounts that are short any calls, like this account is. Before I get into the current portfolio, it's been about a year since I started posting trading videos from this account, so I thought I'd do a quick update on the overall performance of the account over the first year. We can see the account values steadily increased over the year. I started trading very regularly in June, with some big gaps earlier on, but the overall trajectory of the account I'm pretty happy with. Obviously, we've had some big drawdowns along the way when volatility's expanded quite a lot, and we're having one now, obviously, because the price has increased so much in the last few days. The equity in the account is up to about 0.28, and that's starting from 0.25. So in Bitcoin terms, the account's up about 12%. And in dollar terms, when I put that 0.25 Bitcoin into the account, it was worth $9,250. And the current dollar value of the account is just over 26,000, as you can see now. And that's an increase in dollar terms of about 182% at the moment. So overall, I'm pretty happy with the performance. But as I said, I only really started trading properly and in the way I'm currently trading in June. So it'll be interesting to come back again next year in June and see how it's performed over a full year. As you can see here, the account's having a little bit of a drawdown at the moment, and it's actually a bit more than this because I haven't executed a trade yet today, so this hasn't been updated. The primary strategy of this account is to sell short-dated options. That's the part that I expect to generate a profit in the long run. The reasoning is that these options tend to be, on average, slightly overpriced. And this phenomenon of options tending to be slightly overpriced is often called the volatility premium or variance risk premium. And it stems from the seller of the option is the one taking the risk, as they have a fixed profit potential, but potentially unlimited losses. So it makes sense that they would demand at least a little bit of a premium over the fair value of the option, on average. And the reason I keep emphasizing on average is, of course, that it's impossible to know exactly how volatile the underlying will be in the future or where the underlying price will end up when an option expires. So it's impossible to know for a specific option whether it's overpriced with any certainty. But on average, I expect selling these short-dated options to make money long term. And of course, that's the reason why I'm selling them. When selling options, though, you just have to accept that the type of price action we're seeing in Bitcoin now, which, as you can see on the chart, is just vertical. It's basically one-way action, very little pullbacks, and it's doing all this in a very short period of time. So the speed of the move is quick. It doesn't give you much time to adjust any short calls, for example, as you'll see in a second. So you just have to accept that when this happens, you're going to have a drawdown. This is exactly the type of risk that you're being compensated for as the seller of an option. If there was no risk of this type of drawdown when the price moves a lot, then there would be nothing the option seller needs to be compensated for because they wouldn't really be taking much risk. So let's go look at the current portfolio and we can see how screwed a couple of the calls are. So this is the current portfolio. You can see we've got a couple of calls here, one on the 15th and one that's been rolled out to the 29th. And the strikes for those are 74 and 75. And as you can see up here, the current price is 92. So these are very deep in the money now. These are essentially acting very close to a short position in the underlying. But you can see from the equity, we're not down that much. We're only down about 4 or 5% from all-time high in equity terms. And the margin usage is incredibly low. And the reason the margin usage is so low is because of the protection I've got out in June. So I'm already long some calls in June. So if we keep moving up, these will really start to come into play there. You can see the long leg is actually already in profit now. We've increased so much the underlying price. So even though these short calls in isolation are in a lot of trouble, you can see this one's an ROI of minus 405. And it's actually slightly worse than that because I rolled it from a previous expiry. So the original price I sold that for was even a bit less than the average price you can see here. But the portfolio as a whole is still performing okay. It's down a bit this week for obvious reasons. We've had an explosive move upwards. But overall, it's not too much of a problem. I'll continue to roll these calls where I can, though that's going to get more difficult the further in the money they go. But I've got 6 more months of time to roll them while I'm still covered by these calls in June. The more the underlying price increases, the more difficult it's going to be to roll these short calls for a credit, because wherever I roll them to won't be collecting much extrinsic value. But also, the higher the underlying price goes, the more these June long calls and partly a bull call spread will come into play. So if we really blast higher very quickly, yep, these calls are going to have some big losses, but they'll be at least partially offset by the June positions. And also during that time, I'll be collecting more premium by selling more short-dated puts. Obviously, all the puts I've been selling recently have been doing excellently. Whatever I've been selling them for, I'm just collecting all of the credit, unless I close them a bit early, which I have been tending to do. I don't want to hold too many short puts at the same time, because there could easily be a several $1,000 pullback at any moment now. So when I get the chance to, I do tend to buy these back for a few basis points. So in a minute, I'm going to put on some more short puts. And when I do so, I will probably close these short puts because I can buy them back for next to nothing. I've already made almost all the profit I can, so I might as well buy them back. And then I don't have my position size that I'm short the puts is not too large. The puts I'm short will be closer to the money and slightly further out in time, but I won't have too big of a size. So if we do get that big pullback at some point, it'll be very manageable. So without further ado, let's adjust the portfolio now. First thing to do is sell some more puts on November 15th. The puts I'm currently short are on the 14th. You can see those here, and they're already quite far away from price because it just keeps rallying every day super hard. So 15th, I'm not short any puts here. I'll go for the usual range around the 30 to 35 delta. The volatility's popped up nicely here as well, so I'm collecting nice credits whenever I'm selling. There we go, that one got filled. So now I'll go and close the positions on the 14th. Hopefully without having to cross the spread entirely. There we go. Got that filled at about mark price. Could have tried lower actually, but let's try lower on this one. I'll try 6 basis points for this. The mark's currently 7. The price is currently moving around quite a lot, so even the marks will be moving around quite a bit at the moment. The bids and the asks might be moving faster than the mark prices. In fact, they often will be. There we go. So we got filled at 7 there. So that's those 2 positions on the 14th closed. I'm now only short 0.1 puts on the 15th of November. And my delta is still a little negative, so I'm happy to sell more on the 15th, actually. So I'll go sell another one. You can see the price has actually gone down a bit, so we could sell the same one for more. Or I could go for this one. I'll spread it across different strikes. See how that goes. And there we go, got filled on the second one there. So we're now short 2 puts on the 15th, which is in 2 days. I'll come back tomorrow, see how the account's doing. Probably sell some for the 16th tomorrow, depending on where we are. If the price is kept increasing, which based on current evidence seems likely, I might get to buy these back tomorrow at the same time, so I won't have to increase the total amount of puts that I'm short. But that's based on what the prices are, so we'll see how that goes tomorrow. So this is the current portfolio. One other thing to mention, I'm short 2 calls in total here, or 0.2 really. I say 2, I mean 0.2. 2 minimum sized orders basically. And that is a smaller quantity than the total equity in the account. So as the price increases, yes, I'll be having losses on these calls in Bitcoin terms. But the worst that can happen as the price increases, because the size is less than my equity, is that I'll just be forced to sell some Bitcoin at a certain price. So the As the underlying price continues to increase, the dollar value of this account will increase, even if I'm losing a little bit of Bitcoin, at least in the short term. Essentially, what I'm saying is because I'm only short 0.2 calls, but I have more than 0.2 Bitcoin in the account, those are essentially covered calls. Aside from the longer dated cover that I have here, they're also covered by my equity. The goal of this account is actually to increase the amount of Bitcoin in the account. So I'd prefer to also increase the amount of Bitcoin, not just the dollar value. But I just wanted to point that out. One other thing I wanted to look at before the end of the video is the futures premiums at the moment. You can see the order fills there. So if we look on this metrics page, the metrics futures page, and look at this APR column, we can see the effective APR that you would receive if you use dollars or USDC to buy Bitcoin and then sell the relevant futures contract here. And this is the annualized rate that you could lock in at the moment. So it's sort of like an interest that you could earn on any idle USDC you've got sitting around, or USDT or dollars or whatever. Now, these have all popped up a little bit recently, and they're starting to look interesting again. So if you've got any spare dollars lying around that you don't currently want to invest in something else, cash and carry trades are starting to look more interesting again. So it's worth keeping an eye on these. If I just remove the short dated ones from this chart, you can see how these percentages have increased over time. I'll just get rid of December as well. The shorter the date, the noisier the data is for these things. But you can see it's increased quite a lot since even just a couple of weeks ago. So if you wanted to lock some dollars up till possibly September, you could earn 12% now. And if you only wanted to lock it up till March, say, you could earn nearly 14%. These fluctuate quite a bit, but it's worth keeping an eye on these if you tend to be holding some of your funds in stable coins and you would like to earn some type of yield on it. And the way you earn that yield is by using your dollars or dollar stable coins to buy Bitcoin, and then you sell the futures against that. It's called a cash and carry. And there is a playlist describing that in more detail, including some live examples on the Deribit YouTube. I'll put a link to that playlist in the video description. So quite an exciting week so far, but that's it for today's video. Thanks for watching, and I'll see you next time.